Divestment is the process of selling subsidiary assets, investments, or divisions of a company in order to maximize the value of the parent company or obtain better operational efficiencies. Divestment is also known as divestiture. Divestments typically take two different forms of equity carve-out or spin-offs. Let's go through some of the differences. A spin-off occurs when a parent company distributes shares of its subsidiary to its shareholders, resulting in the subsidiary becoming a standalone company. As the parent company distributes 100% of its ownership interest in its subsidiary as a stock dividend to existing shareholders, instead of selling it to the shareholders, the parent company typically receives no cash consideration or sale proceeds for the spin-off. Spin-offs are most common among companies that consist of two separate and distinct businesses that have different growth or risk profiles. A spin-off may occur for various reasons. A company may conduct a spin-off so it can focus its resources and better manage the division that has more long-term potential. Businesses wishing to streamline their operations often sell less productive or unrelated subsidiary businesses as spin-offs. For example, a company might spin off one of its mature business units that are experiencing little or no growth, so it can focus on a product or service with higher growth prospects. Alternatively, if a portion of the business is headed in a different direction and has different strategic priorities from the parent company, it may be spun off so it can unlock value as an independent operation. A company may also separate a business unit into its own entity if it has been looking for a buyer to acquire it but failed to find one. For example, the offers to purchase the unit may be unattractive, and the parent company might realize that it can provide more value to its shareholders by spinning off that unit. Unlike a spin-off, an equity carve-out occurs when a parent company sells a percentage of the equity of a subsidiary to the public or outside investors. This is also known as a partial IPO. However, the parent company usually retains a controlling interest in the new company and offers strategic support and resources to help the business succeed. Unlike a spin-off, the parent company generally receives a cash inflow. An equity carve-out typically happens as a form of financing technique to raise funds. A parent company might also undertake an equity carve-out to reduce exposure to riskier line of business or achieve corporate downsizing.